Hey everyone, welcome to the KE Report and a daily editorial featuring Mike Larson. Mike is the editor-in-chief at MoneyShow. Mike is one of our great generalist commentators here, where he takes a very broad look at these markets and tells us when a time to be aggressive and a time to not be aggressive. And right now, boy, oh boy, I feel like with all this uncertainty in the markets, very interested to hear what Mike has to say. The last time we had Mike on the show was at the tail end of January. Feels like very different market environment now. Mike, let's start off with a recent recap of the most recent conference that the Money Show put on back in Vegas. That happened mid-February, really right before the markets turned over. Give us a bit of an overview, Mike. What was the vibe like? What were people focused on at that conference?
Yeah, absolutely. Thanks for having me on, guys. It's interesting in mid-February that we came off of two very good years from the S&P, up 23, 24%, and we had a pretty good start to this year as well. A lot of optimism, AI stocks kind of really taken off. The high momentum parts of the market, whether it's AI, whether it's tech in general, whether it was Bitcoin and other cryptos, a lot of momentum heading into February. And, people were clearly curious as to what was driving it. They were happy that they were making money, but they kind of wanted to know where things were going to go. And then the back half of February and the first part of this month couldn't be any different. One of the biggest falls or shortest falls and most ground covered for the S&P in a long time. Market sentiment along some of these AAII readings and things like that, investor sentiment got as bad as it was basically since the 2022 bottom back in October of that year, and before that, going all the way back to the COVID low in 2020. So, you went from extreme optimism to kind of extreme pessimism in terms of sentiment and so on in a very short period of time. And even though the S&P kind of just tabbed that correction period down 10% from its highs. You look at some of those momentum stocks, again, smaller tech names and cryptos, they really got crushed. And the NASDAQ itself did poorly with the Mag 7 names getting hit pretty hard. So, big swing in sentiment. I think people are looking for answers, that they were happy with how things were going, but they were kind of curious as to what was going to happen with the new administration. And let's be honest, since then, it's been a lot of back and forth, a lot of volatility. One of the pieces I penned back in January, or excuse me, I think it was the first week of February when things were still doing very well. I said, this administration is going to make volatility great again, regardless. And that's two-way volatility too. People typically say, oh, volatility just means stocks are going down. And that's obviously when the VIX tends to rise the furthest. But you've seen volatility increase overall and the volatility be two ways. If you go back to sort of Trump 1.0, what was the lesson of that environment? You'd wake up one morning and there's a headline saying China-US trade negotiations deal imminent. And then 24 hours later, you'd read China-US trade negotiations deal falls apart. And we'd have these days where we'd be up 3, 4, 500 points on the Dow, and the next day we're down 3, 4, 500 points on the Dow, and so on. I think that's clearly what we've been seeing here in the broader averages. While you've had the sort of, the sub story, the underlying market story of, AI stocks flying too close to the sun and getting burnt, you've also had, just more generally speaking, rising volatility, markets overall swinging around a lot more. Waking up Monday, the tariff and trade plan is X, and then Wednesday, the trade tariff plan is Y, and then Friday it's Z. So you get an environment like that, and it just leads to people kind of pulling in their horns, looking for volatility protection, and basically looking to readjust to the realities of this new regime. I think people got the expectation that Trump 2.0 was going to be just like Trump 1.0, where a lot of the tariff talk was kind of just that talk, and there would always be last minute deals. This time around, Wall Street, one of the reasons it's pulling back quite a bit, and again, outside of things that were just like AI, which got too hot for its own good in the broader markets, it's because people are realizing, he's willing to put up with volatility. He's less willing to do his Trump put, so to speak, and back down when there's, issues that he thinks are longer term that he wants to try and quote unquote fix via trade and tariff policy.
Well, Mike, in light of all this volatility and trading by tweet, and I think that was a great line that you had, making volatility great again. It does move in both directions, so we've seen more volatility to the downside and the upside. A question for you. You mentioned AI stocks flying too close to the sun. Well, we had that big news, and I don't even know if we covered this the last time we talked because it may have happened in between, but that DeepSeek news where it kind of torpedoed the AI section, that was kind of a shot across the bow, and some people have noted there was a tenor change even before some of the tariff volatility began. How much of this is just multiple factors? How much of this is just tariff related? Because we hear that as the single bullet, but it seems like the markets were also at very high valuations and just looking for an excuse for people to pull profits. How are you looking at the corrective move we've seen in general equities through the lens of there's more going on than just tariffs here?
Yeah, I think that's a fair point too. I mean, the deep seek issue, you never really know how much of it is fluff versus how much of it is true. And some of our speakers at the event, deep seek had happened before the Vegas event. The real sell-off in markets didn't happen until after because that was kind of mid-February, early to mid-February that we were in Vegas. So the deep seek news is out there, and some of the tech specialists that spoke there, Mark Mahaney of Evercore ISI and so on, highlighted that really it's not as cheap as they were trying to say it was. They actually relied on, yeah, on a lot of other stuff that if you factored in some of those additional costs, it was not the huge divergence between what their model and their technology cost to make work versus what some of the big US tech companies, the Microsofts and the Metas of the world were paying. So there was, a little less than meets the eye, and that's why we kind of had that initial bounce back. But I think, you really do, more broadly speaking, have to kind of put it at the feet of, a couple things. Uncertainty about policy, because whether you're a business or an individual, you got to at least have some basis for your planning. And if you don't know if one day, importing something from a country is going to cost you 10% more, and the next day it's 25, and then a week later it's nothing because they came to a deal, that stuff's going to mess with your long-term planning. So a lot of things are being rethought there. And from a trader standpoint, again, the one everybody was hoping, and this is, why the markets rallied ahead of the election when it looked like from polling that Trump was going to win, and then after the election when it was clear that he did, you had a lot of assumptions that we're going to get tax reform quickly, and that's going to help, keep the tax cuts in place, maybe have some new cuts to help the, the economy. You're going to have regulation get rolled back. You're going to have tariffs be mostly used as a bludgeon versus an actual thing that gets enacted. And if the market falls, Trump's going to back off and say, it's okay, never mind. And those were the sort of the four pillars of why the market ripped before and after the election. So what's happened to those pillars, right? Negotiations are getting bogged down. We're not really getting anywhere with that. I mean, eventually something's going to happen, but it's eventually going to be 6, 9 months. Who knows? On the regulation, you are seeing progress on that front. Obviously, regulations are being rolled back, but at the same time, you're getting some of this Doge stuff, which is going to hurt employment. I mean, whether it's necessary to reduce the federal deficit or debt, I'll leave that to other people to argue on both sides of the aisle for that one. But from a Wall Street perspective, it means, weaker growth because you're firing tens of thousands of workers. And so, that's kind of a mixed bag on that front. As far as the Trump put, you've had individual after individual come out, and not just when stocks are taking a breather and are rallying, but when they're tanking 5, 6, 700 points on the Dow, you have Trump officials coming out and saying, we don't care. We're willing to put up with turbulence because we have a longer term goal here. So, basically and obviously we've already talked about the trade and tariff thing. So of these four pillars of the rally, you've basically completely kicked one out from under, which is the Trump put. The trade and tariff thing, you've pretty much kicked that leg out from under the stool. Regulation, you kind of get half a leg there, maybe three-quarters of one. And taxes, you got, eventually there's going to be a leg to the stool, but, maybe it's going to be down the road. So that's why I think the market's struggling. And I think that's probably why, even as we bounce back from the recent lows, because sentiment just got so ridiculously negative, I was expecting a rally. We've gotten one, and I wouldn't be surprised if it goes, a little further. As far as, are we going to get something completely sustainable? Well, we got this April 2nd deadline coming up, and it could be moving forward that a lot of these things that are already causing volatility aren't going to go away.
Yeah, there's just so much uncertainty out there, right? I don't think people did expect Trump to go this hard on tariffs and, quite frankly, not care about the market falling. But hey, he could always change his tone. But if we look more big picture, yes, markets are down. The US dollar is down. Rates in the US broadly in the middle of this range that it's traded between for a year and a half now. The real winners seem to be gold. That continues to do very well, over $3,000 an ounce. Also, international markets are doing well. So, where are you seeing the opportunities out there, Mike? Is it very much outside of the US?
Yeah, well, it's crazy because, if you go back to, again, right before and right after the election, what were sort of the assumed things that you would see happen? What were the market narratives? The dollar is going to soar because the U.S. growth is going to outperform, and what Trump's doing is going to drive rates higher, which therefore is going to support the dollar vis-a-vis other countries. Other countries are going to be, sort of flickering in the wind or flitting in the wind, not really knowing what to do. So their growth is going to be worse. Their markets are going to be worse. U.S. stocks are going to outperform. Things like gold are going to suffer from higher rates, higher dollar, and so on. I mean, that was the narrative, right? but it's completely been turned on its head. I mean, it's amazing to look at the philosophy is make America great again. But, when it comes to stocks, American stocks are like woefully underperforming. There's a great chart somebody posted on Twitter yesterday that showed just basically all the ETFs. Poland is up, I don't know, is outperforming the S&P. The Polish ETF here in the US is outperforming like 30 percentage points. Sweden's outperforming like 18. Pretty much pick a European country and it's outperforming by 15 to 30 percentage points. China is outperforming the US, and obviously China is getting, one of the countries smacked the most from Trump's tariffs, so that's what he was targeting. Mexico, Canada, those ETFs are outperforming the US S&P. So you got all that going on. The dollar's been giving up its gains. Long-term interest rates have been coming down on fears that tariff stuff's going to weaken the economy, even if it's going to also push inflation a little higher. And gold, holy cow. I mean, a couple months ago, I laid out my sort of coming into the year, my 3K in Q1 forecast. I was really thinking, this is going to happen. We're going to get it in the first quarter. Gold's going to break that 3K barrier. I was getting a little nervous for a while there because we were closing in on the end of the quarter, but sure enough, obviously we've hit that on futures and spot here in the US. And I think that, gold needs a breather after a big run. We're talking here before the Fed. Who knows what the Fed's going to say and what's going to happen after that. But I think, gold probably takes a breather. But overall, I'm still bullish on gold as an asset. I mean, if you think making volatility great again is your underlying belief, then what do you want to own? You want to own gold. Why are central banks buying gold? Because they don't want to end up stuck owning a bunch of U.S. assets in a world where those kinds of things can get frozen, and or belief in the dollar and the stability of the U.S. economy, U.S. rule of law, and all that is being questioned to some degree, and money is being spent in other countries. I mean, geez, you saw what Germany just did. They basically threw out decades of worrying about deficits and so on and saying we're going to start spending a lot more money to support the economy and build up our defense, capabilities and so on. What does that mean? That means stronger relative growth outside of U.S. borders. So you throw it all in a pot, and I wouldn't be surprised. I mean, if the narrative reversal, I guess is a good way of thinking about it, does actually last. And you are going to want to be, as a U.S. based investor, looking at some of these undervalued markets that have been, sucking wind for so long. As far as gold, silver, I mean, shoot, I don't want to say something like the sky's the limit, because I'll probably say that and then gold will fall $50. But I don't think this run is over, not by a long shot, because I don't think any of the underlying conditions, I mean, we're due a pullback, but any of the underlying things that are driving it are really going away.
Well, Mike, just in lieu of that, as far as the potential for gold to still keep garnering a bid, not just from central banks, but also from investors, there's also been clearly a ton of buying, not just on the central bank level, but also out of the East. The question is, are Western investors going to get more engaged? There has been some upticks in volume and some of the ETF inflows compared to where it was, because we were seeing a gold price rally at the end of last year, but Western investors not participating. How do you think this foretells what's going to happen in the gold equities? Gold equities have finally started taking off, kind of getting off the mat a little bit. They've been building some momentum in 2025, but they are still equities. So they have a foot in both worlds. They have a foot in the commodity world of the underlying metals, but they also have a foot in the stock market and the equities world. So which way are the gold equities going to get pulled here?
Well, look, I love the work of Brian London. I'm sure you guys follow his stuff too. And he made a really good point in a column I just read and I digested in our newsletter too. He pointed out, look, the last time there was a generational opportunity to make money in gold and mining stocks was back in 2000. And he pointed out, that took a lot of conviction to make that call, which he did at the time, because everything was doing terribly. Gold was doing terribly, miners were doing terribly. His point was, you've had gold and now more recently silver doing very well, yet the miners are just starting to move and just starting to get into that trend. So he thinks that, if anything, there's a lot of catch up to be done in terms of where the price of the underlying metal is vis-a-vis how much the mining stocks and equities have performed. So his point is that, again, back then, the last time gold and related equities had a phenomenal run, it started in 2000 when market conditions were terrible. This time, market conditions have been great for the metal, but the stocks haven't done as much or haven't really reacted in the way you'd expect. So he thinks this is really going to run. And even some of the other specialists, again, I mean, me, I'm a generalist. Some of the other specialists that I follow, the Omar Ayalases of the world, so on, their point is similar. Like, juniors and things like that. This is their time to shine, pardon the pun, and they really think there's a lot of legs to the move.
It really is their time to shine. The metals are doing their job by moving higher, even silver. Now it's time for, I guess, investors to take more notice. But circling back around to the conferences that MoneyShow does, What is the general vibe around gold? Do people care? Especially the generalists. Do they care? Are they interested in it, or are they still just distracted by other markets?
Again, I think some of it's just generational. And some of it's, Bitcoin is the new gold and crypto is the new gold. So why do we need gold and so on? I hear that a lot, and I think people will continue to be interested in crypto because it's the new and shiny thing, and shiny obviously is sort of playing off the pun here. I think the longer you have a situation like we're having so far this year, where quote unquote digital gold is not giving you the returns that real gold or other metals like silver is giving you, and the longer people it starts to sink in that hey, things like Bitcoin and crypto are more tied to the tech sector. They're not really pure digital gold. They're digital gold, but also tethered to what NASDAQ and tech stocks do, let's be honest. Whereas gold is a pure kind of insurance, value protection, so on type play. The longer that goes on, the more you're going to see money rotate into, I think, metals and equities related to it. So, I honestly still think, and again, I'd be more worried as a bull if there was rampant optimism, like, holy cow, people going on message boards and TV talking about Junior Miner X and Explorer Y and so on every 5 seconds, but they're not. Eventually, we'll get to that point if, as Brian suggests and some of the other guests have suggested, this move really turbocharges. But for now, they still want to talk AI. They still want to, they still think that the speculative AI plays, are sucking up some of the speculative juices that you would have previously maybe seen 10, 20, 30 years ago in junior miners. But I think that probably changes. Again, the longer that gold and silver perform, but the digital stuff that was supposed to replace it doesn't, because it's, let's be honest, tied to what the tech sector is doing, that's going to convince and bring in more buyers. So again, I think we consolidate soon. I wouldn't be surprised with a pullback, but I mean, 3K is a big story to me in the underlying metal. The fact that the equities are now starting to perform is another big part of this story. And I think that, I think it's got legs.
Well, Mike, you bring up a really interesting topic on the gold versus Bitcoin. Of course, that debate has been raging for years in the markets, and people all have different opinions on it. But when we saw the 2020 pandemic crash, gold definitely held its ground better than Bitcoin did, and some of the altcoins and some of the crypto miners. So when faced with a real crisis, gold still got a better bid. And to your point, the cryptos really tracked the Nasdaq more like a tech stock. That same thing's happening now that we're seeing a lot more geopolitical concerns, because it's not just the tariffs. There's also still wars on several fronts going on out there, and there's a lot of tensions, not just physical wars, but there's kind of a trade war going on. And gold has held up well, where again, Bitcoin did amazing at the beginning of the year, but has pulled back with the tech stocks. And if there's a corrective move that sustains itself in the tech stocks, it's acting like it's not digital gold. It's acting like a tech asset. So do you think there's going to be a divergence in opinions of, is Bitcoin really a safe haven? I know that there's some scarcity aspects and some elements that are like hard money, but it's just not holding up well when we're seeing real tension hit the world.
Yeah, yes, it's my short answer. I agree with what you just said. And I think, the realization is going to, sort of sink in the longer this goes on. I mean, I've just kind of talked about what's happened in the last couple of months and, the fact you can kind of overlay a QQQ chart with IBIT, one of the leading Bitcoin ETFs, which is what I was just doing on my other monitor here. They track pretty closely. I think that yes, tech continues to underperform. If money rotates out of Mag 7 and some of the super hot tech names and things like AI, and it goes into foreign stocks and the dollar falls and gold equities, and related metals equities continue to outperform, you can only, as a big portfolio manager, you can only swim against that or ignore that for some time before you start having to answer to your committees and your, investors and so on. So I think that this could be the year that the broader market, the generalists, kind of wake up to this and start looking for ways to play it. So it could be a very interesting year, a year where a lot of things that have kind of been out there, floating around there, and a lot of sort of realization moments, the aha moments, or whatever you want to call it, amongst mainstream investors really kick in. And that's the kind of thing that gives this subsector and the people that are sector specialists some real tailwinds. But again, all that said, in the short term, yeah, I think, we're probably going to need to correct or calm down a little bit and then, set the base for the next move up.
We hear so much about this when the generalists will come in. What does Western demand look like? Look, the metals price has been moving nicely higher, and the stocks are doing well right now. So, Mike, what will show you that the generalists are coming more into the sector. Arguably, we probably have seen some generalists coming in. So what do you look for?
Yeah, I mean, some of it's sort of qualitative. The guests you see on television, the people talking about stuff on Twitter or social media, is it just your types that you know are specialists in the sector, or are you seeing a gold or a mining expert on CNBC every 20 minutes, which you're not seeing, or Fox Business or whomever? I think part of it's qualitative, part of it's quantitative, and just that the ongoing divergence and the expansion of, how much of a sort of a gator jaw opens up between how GDX is performing versus QQQ. You kind of get that image of one going up and one going down, like making the mouth of an alligator. The longer that goes up, and if it really starts to spread or widen the divergence there, and there's ridiculous amounts of volume coming into one and out of another, that's the kind of stuff that's more quantitative. How do you see the ratio, the difference between things like GDX and QQQ get, and so on. So a little bit of qualitative, a little bit of quantitative, a little bit, the famous definition of obscenity. I'll know it when I see it and what have you. I don't think I'm seeing it in the longer term. At this point, I don't think that we've sort of tripped that threshold in any kind of speculative mania. And again, arguably for a bull on metals and juniors and things like that's kind of how you want things to be, because it means you got more momentum or more potential buyers to come in and lift prices.
Yeah, that's so true. Well, and also look at the volume too. Volume still has been relatively low in GDX, but still could be plenty room to run. Just very interesting to see really international markets and gold outperforming the US. Who knows how long this shift is going to last, or if this truly is a generational shift in markets that we could be at the early stage of. It's so hard to tell right now with all this uncertainty really stemming all from the US and Trump as now president and doing what he wants when he wants. Mike, always great chatting with you. Again, Mike Larson, editor-in-chief at Money Show. Click the link in the show notes to find out more about the upcoming Money Show conferences. Mike, thanks for your time today. We really appreciate it.
Great. Thank you. Happy to be here.